Most people think raising capital is about charisma, a deck, or having the right network. But today's guest learned the hard way that raising capital actually breaks down to systems, the follow up, the investor experience, and the back office chaos that no one talks about. Before founding Homebase, Domingo Valadez was a real estate syndicator himself, raising millions, going viral, crowdfunding deals, featured in Blockwork and The Block, and building out an investor database of over 3,500 accredited and non-accredited investors. In this episode, we unpack Domingo's journey, how he got to real estate, how he transitioned to Homebase, and all the different caveats and curveballs along the way to really highlight why there's a different avenue to growth for everybody and how you can find the most strategic way to grow. Mingo, welcome to MyFinJourney.
Thank you so much for having me on, Mustafa. Super excited to be on.
No, it's our pleasure. So Domingo, talk to me about what you were doing before you were raising capital for real estate.
Yes. Prior to this, I was actually used to do product strategy at Google. So I was there for about 5 years. Used to live in San Francisco. Touched all types of ad products that we worked with a lot of advertisers on. Always knew I wanted to get into real estate. My parents did a lot of real estate investing growing up. They were dentists, but they used to do the classic like buy single family and then get into development. And so I grew up going to a lot of open houses as a kid and seeing that firsthand. And even when I was at Google, I bought a fourplex. Did something really dumb, which was empty out my 401k to buy a fourplex, which honestly, looking back on it, ended up being a good financial decision. But in the moment, I'm like, I feel like this is not what you should recommend your kids to do. But no, it was great. And then did that for about 5 years and then started Homebase about almost 4 years ago.
Awesome. So Domingo, talk to me. You said you grew up kind of around real estate. You mentioned that your parents are dentists. Was this in the California, the San Francisco, the Bay Area or somewhere else?
No, so I grew up in South Texas, like basically on the border. It's in a small city called McAllen, where like 95% of the population is Hispanic, but a really great place for real estate investing. And even the properties that we crowdfunded in my early Homebase journey, we crowdfunded 2 properties in McAllen. So happy to talk about that and everything we learned along the journey. But yeah, that's where I grew up.
And those were single family homes, correct?
Single family homes, yep.
Okay. So the strategy was what, like a burr? Or was it a fix and flip? Or what were you guys doing?
Yeah, so Homebase started off as a crowdfunding platform. And so we used to let anyone invest in fractional real estate for as little as $100. We found 2 single families in McAllen, Texas. Those are the properties that we acquired. We even were diving into crypto. I don't know like how deep you go into that, but we were tokenizing the properties. We were the first to do it on this blockchain called Solana. Ended up going viral for doing it. And then that's how we built our investor base, about 3,500 people in about a year. And then learned all the ins and outs of what it takes to syndicate a property, from fundraising, investor management, compliance, K1s, all securities law, like end to end. We learned it firsthand, even how to build like a B2C platform and scale that.
That's awesome, Domingo. So help me kind of bridge the gap between, working at Google in product development, product management, to essentially building out your own tech platform, right? What was the thought process? Was this what you were looking at day one when you were making that first investment in, I believe it was Texas, or were you kind of thinking something different?
Yeah, so like a lot of the motivation stems from like going back to my parents. They started their own dental practice, and so I kind of got to see firsthand entrepreneurship from like the early days where we had like nothing, and then to them growing their business, and then now living a comfortable life, and kind of got to see the American dream firsthand. So I always knew I didn't want to work for someone else, for my whole life. Just didn't realize it was going to happen so early on. But was at Google for about 5 years there. And even while I was there, I was always like, okay, I tried starting a leather jackets business on the side. I got into drop shipping, a lot of like small business ventures that ultimately weren't going to be my full-time job, but it was fun to kind of experiment with that. And then I think at a certain point, one of my colleagues introduced me to her now fiance, and we just really hit it off. He is a mechanical engineer, really likes real estate investing, and we were ideating around a lot of different, types of businesses we could build. So at a certain point, we were even looking at like property management companies, and if we could like fix expenses so that we can give real estate investors like very stable projected rents, but of course charge a fee for that. went down this whole rabbit hole there. Multiple startups actually raised a lot of money in that category, but we did not do that. And then came to the realization that like real estate's just gotten so freaking expensive in the US. How was it easier for my parents who came here with nothing to buy something than it was for me being at Google? I could not afford anything in the Bay Area. And so it was like, okay, what if we start Homebase as a way to give people access to this investment class in which a lot of people have made a lot of money? And so that was kind of the whole motivation behind it and what led us down that path.
That's awesome. That's awesome. I think that story resonates with a lot of people in terms of home ownership becoming really expensive. But I guess bridge the gap for me a little bit because, I think of things very similar, Domingo, but I really want to kind of peel back the layers because we're talking about how expensive home ownership is, but this product doesn't solve for that. It creates an investment class that people can invest into single family homes. So for you, if you're looking at Homebase 10 years from now, is there a strategy to address, housing affordability? Or is it always going to be that it's more of an investment grade asset class that you guys have created and want to scale?
Yeah, so I'll be clear in that we don't do crowdfunding anymore at Homebase. We've completely pivoted out of that business and happy to talk about why. But the early motivation was if you think about most of America's wealth, it's tied into people's houses. And so inherently, it's usually just like the boomer generation and above that got access to that. A lot of younger people like resort to other means of trying to find wealth quickly. You can think of like, Robinhood making options trading easy, the amount of gambling ads that we see. It's like so much of that now is like quick money to make just because more stable investments just feel so out of touch to, I think, the average person. At least it's my belief. And I think we're kind of seeing this happen firsthand. So yes, like you weren't going to be a homeowner, but like the fact that we went viral, there was a lot of demand for this. Like we had way too many people that wanted to invest for the amount of slots we had available. Like there was real people that wish they had access to real estate that just can't afford to get that because they don't have like, the minimums required that most GPs require from investors. And so our idea was like they're getting access to the upside. They're getting the debt that comes with, usually getting a real estate investment property at a much lower price point.
And from your perspective, what are those minimums that GPs, real estate syndicators, what are those minimums that people are typically charging or requiring?
Yeah, typically 25K, which is still like really low. For you to buy a house outside of like super rural areas, usually it's going to cost you like, I don't know, over 100 grand just for a down payment to get a house. And so for you to be able to, get into an investment with 25K, still breaking down that barrier. But we even went one step further, making it as low as $100, which is just like crazy low. Yeah.
And why do you feel like somebody would set the minimum to 25K, especially since you guys can do it at 100? Like, what is their motivation?
Yeah, I mean, we learned this firsthand. Usually when people put in not that much money, like you have a lot of investor relations that happens. You have a lot of different investors that are now participating in the deal and they want to know what's going on, give me updates, how's my investment doing? We were building a platform that allowed us to kind of share a lot of this communication at scale, but GPs don't always have that platform. They're the sole person investing in a deal. And now they're the ones that have to manage a relationship with every investor. And so the more investors that you have involved in a deal, that's the more amount of time and effort you have to put into your investor relations. So the less people you have to interact with, the better and easier to scale that business. So that's why you put in these minimums. You want to get people that are more committed to you. So you have less, investors you have to interact with to get a deal done.
So it's a byproduct of scale. Right? You don't have infinite time. You got to spend your time managing your property. If you're spending the time kind of supporting the investors, it's hard to actually get them the return that they're expecting. So I guess that seems to kind of explain the pivot that maybe Homebase made from deploying their own capital or raising capital and crowdfunding to their own transactions to really setting up the infrastructure for real estate syndicators and GPs. Help me kind of understand, what led you to identify the need to pivot?
Yeah, so we never felt comfortable crowdfunding investment for other GPs. I know there's other platforms in the market that started, just being a marketplace that allowed GPs to crowdfund from investors. I think that ultimately leads to misaligned incentives where only the deals that people can raise for end up getting put on these platforms. And then there's no downside for the platform. They just care about more transaction volume. And so they just want more people to get into the deals. And then as investors, like just time and time again, I think we've seen that a lot of these crowdfunding platforms did not do well for the investor ultimately. And so what we did was we wanted to manage every deal. Of course, that does not scale very well when you're operating every single deal yourself and you're doing single family and in an interest rate environment that's like got, super high in a very short period of time. But in that journey, we learned all the ins and outs of syndicating, from like, how do you manage all these different investors? How do you actually get them to commit capital? How do you close on that capital? How do you then put together, all the legality around this, manage that communication, actually operate the property? And we built a lot of infrastructure for ourselves to do that. Then last summer, we started getting reached out to by different GPs, just being like, hey, we've seen you guys. Can we use, your platform to host our own deals and manage our own investors? And so at the time we looked at the market, we didn't see that any player in the space really had, that big of a market share. It was incredibly fragmented, which to me tells me that there's not a player that everyone loves. Like, if you think about the search business, thinking back to my time at Google, when was the last time you heard someone say they use Bing? It's always like, I use Google search. Now it's moving to ChatGPT, but there's clearly a market dominator because everyone uses it and loves it so much. That was not the case in the fund administration or syndication space. And so we decided, you know what, let's pivot into it. Let's build a really modern stack. And we've gone from about 8 GPs in January to over 125 in December. And it's been a very busy year for us.
Congratulations on scaling. I'm sure that hasn't been easy, but also exciting.
It's been a lot of fun. I mean, with that journey, a ton of ups and downs. I mean, I've been an entrepreneur now almost 4 years, so you can imagine we've had some very painful moments. We've also had some amazing moments. So happy to dive into everything there.
Yeah, I look forward to it. I mean, before we continue, I just wanted to take a pause for a second and say that if you're listening to this conversation and you're finding value, hit the subscribe button. We drop episodes like this every week with the intention of genuinely adding and creating value for you. So if any of these stories and strategies help you build wealth, share this episode with a friend. Domingo, I wanted to understand, you mentioned that you went from that pivot of raising capital for your own transactions to providing the infrastructure for other GPs. So help me understand, Domingo, how much capital did you raise for your own transactions?
Yeah, so for my own transactions, we've raised around 500K.
Okay, nice. Congratulations.
Thank you. I mean, I've also raised money for Homebase. So I've seen two very different types of fundraisers.
I'm sure.
From like
it's
real
it's very
estate.
different. So talk to me about
Yeah.
that. Yeah.
I mean, very different product that you're selling, with like you trying to get investors to angel invest or venture funds to invest in a company. Like, they're very much betting on you and your team. Not too dissimilar as an early GP when you're raising for friends and family, where they don't really care as much about your deal. They care more about you and that you're going to be a good operator, and they trust you as an individual. But ultimately, the product you're selling, you're probably not going to lose all your money in real estate. You should not lose all your money in real estate. Real estate should be a very stable investment that has like 15 to 20% IRR depending on the GP and the type of asset class. Meanwhile, venture, 0 to 1. So it's either going to be like you're going to make okay money or like a home run, or you lost everything. So I think there's a bit more risk when you're raising for a company, but I think people know that. But I'd say that's harder to close in my opinion than capital for real estate.
And you feel like it attracts different investors?
Oh, absolutely. Folks that are a bit more different parts of an investor, I'd say, like people that are more risk prone, but like if you're going after family offices, a lot of times they're investing in both real estate and they're investing in both venture. It's just a matter of like how they're allocating the risk. So they'll be more forgiving for an early stage company than maybe they would be for a GP who's coming in with like, a business plan for a value add deal they want to do. They want you to be like very meticulous and buttoned up with that. And maybe they'll give more slack to like, a seed round for a business.
I love it, Domingo. I think it's very insightful. So for you, with respect to your real estate investors, right? For a lot of people, 500K might feel like a lot. It might feel like a little. It's almost immaterial. The fact is, from my perspective, you got some deals done. Were those investors from the same geographic areas as maybe your seed investors for Homebase, or not really?
I mean, they're all based in the U.S. So I'll say that, but all different states across the U.S.
Okay. Awesome. And for the GPs using your platform, do you know how much capital they've raised?
Over 250 million of equity under management across those GPs.
Okay. And that would be equity, not investor capital, correct?
Investor capital, sorry. So it's like, not assets under management. It's above 250.
Okay. And from how many investors roughly?
Over 250.
Okay. And for you, when people are choosing to go with Homebase, what do you feel like they're looking at? Why are they choosing Homebase versus Appfolio, Avestor, InvestNext, any of the other different products that exist in this potentially fragmented market?
Yeah, I'd say 3 core reasons why folks go with us. And we've tried to be very intentional about this. I'd say the first is just the user experience. Like, we came from building a crowdfunding platform. We got really good at investor flows, from like them signing up to then completing the investment to then tracking how things are going. we had over 3,500 people make accounts. So we had to get really good at that. And I think our user experience speaks to that. I think people really like when we do demos and get to see that, end to end. Secondly, I've been really intentional about building a community. Like I think I was talking to you before the show started. We run a podcast. We interviewed different real estate GPs on it. We now have over 125 GPs on Homebase. I made 45 intros last month between GPs, co-GPs, fund managers. People have gone on to invest together, do deals together. Like people usually only get this in masterminds. I'm trying to build that community in like the software service that we're, letting people get into and bring that level of value. And then the last thing I'd say, our pricing structure is a bit different than existing players. Everyone always wants to tie software to like some percent of assets under management. We think people are very tired of paying that. We charge just like one flat fee. For the majority of people, it's $500 a month. And we host any number of like investors, deals, AUM, co-GPs. So people really like that they get access to all the tools for one set price without that scaling year over year.
Beautiful. I love it, Domingo. From your perspective, right? You kind of explained how your family, they're both dentists. Most people say dentists are highly educated. You went to work for Google, probably very, very intelligent as well. You kind of alluded to like affordability challenges with respect to like buying a single family home, probably because that's in the Bay Area where things are easily over $1 million for something that's probably like 40 plus years old. Ultimately, you decided to leave Google to focus on this company, the startup, which is a very Bay Area, Silicon Valley type thought process. Let me start my startup and scale it aggressively. For you, when you think of like the most efficient path to wealth, what does that look like for you?
It's funny because I think there's been studies done that you should be an employee at startups, not a startup founder. The expected value of you making money is much higher as an employee. If I had to think about, like, at least for me personally, I think the best path to wealth creation was being a startup founder, just because I always knew I wanted to start a company at a certain point. So do it when I still have less to lose. And before you have kids, before you're married, and like, you have people that are relying on you for, to sustain them in different ways. I was also close to going down a path in finance. I went down like the investment banking path, and then that probably would have led to like private equity. That's also a really good path to building financial wealth. Although I'd say like not many people get access to that. It goes back to like inaffordability. The paths to wealth feel really difficult now, hence why people look to more extremes to either like win big or not, which I think is just what's tough with this economy, which is why I originally started Homebase to get more people access. But yeah, I'd say like startup founder, at least for me, felt like one of the best paths to building wealth.
So if you were listening to this episode, Domingo, and you were thinking like, hey, he's saying working for a startup is the lowest risk profile. To me, the natural progression is, hey, is Domingo hiring? So is Homebase hiring?
Right now we are not. We just hired someone. We're temporarily pausing hiring, but maybe in 6 months' time we'll be hiring again.
Awesome. So if you're listening to this and it's about, let's say, June 2026, reach out to Domingo. They might be hiring. And if they are, that's good. That means they're growing in the scaling and you want to be an early adopter. Domingo, I mean, talk to me. I think you've alluded to a decent amount about affordability. We're talking about somebody working at Google in a decently high position. I assume you were an accredited investor at Google. Is that a fair assumption?
I'd say I was making my way to an accredited investor. Okay. Yeah, because I think you have to have $1 million net worth or 250K in. Yeah, I think when I quit, I was just about to be in the accredited investor category, and then I quit.
Okay. So and for the audience, typically somebody who's accredited is an individual making 200K or more for the last 2 years and expected to this year, or like Domingo mentioned, maybe they have $1 million in net worth. Domingo, for example, his business is probably worth more than $1 million, so he would probably be accredited today. In that situation, Domingo, right, for the average American, maybe not the average person you talk to or I talk to, but for the average American, making over 150K feels like a lot. Speak to me / the audience about your perspective living in the Bay Area with a lot of other people who are in tech, who had high incomes, but it didn't feel like you could actually breathe. Specifically, I want to understand, the idea of golden handcuffs with respect to either high income earners or high income business operators or startup founders.
Yeah, I mean, there's a lot of money that's tied up in private companies that people can't touch those funds until there's a liquidity event. And so even though theoretically you have a paper net worth of a few million bucks, you can't do anything with those funds until there's like a big liquidity event. And so even though theoretically it looks like your net worth's going higher and higher, you're really, your financial situation might not change at all until that liquidity event may or may not come. And that may happen in 3 years, in 5 years, in 7 years. So that can be very challenging too for a lot of folks in the Bay Area. Unless you're working at like a public company, then that's not a big deal because you can sell, but it's for folks that work in the private sector.
That makes sense, Domingo. So help me understand why you decided to raise capital for the startup. Obviously, you have your parents, you saw their dental practice scale, you saw that, probably positively cash flow early on. I assume they haven't raised capital for their dental practice. Most dentists don't do that. They go like the DSO route or they sell to big dental offices. Um, for you, were you thinking about, not selling equity and not raising capital and just kind of bootstrapping? Walk us through, the thought process.
Yeah, we basically didn't pay ourselves for the first year. I think after a year of starting a company where you're not paying yourself, it gets really tough. And so I think we raised capital originally just to fund the business. So we weren't paying ourselves, but we were paying for like legal costs to like figure things out, for like tech and actually like pay services, for example, to like AWS to host a lot of these things. So we raised capital for the operations of the business originally, and then a year in the journey, we were like, okay, we actually need to sustain our lives, and so then we raised actual capital for that, and then we raised a little bit earlier this year to help us expand the team a bit, which we did. Then if we hit the growth targets that we're looking to hit going into next year, we'll probably raise some more capital just to keep continuing to scale the business. Because at a certain point, there becomes a mismatch. Like I would love to bootstrap the entire business, and I think by bootstrapping, I'm using it as a loose term. We'll probably keep doing friends and family rounds. It's kind of my goal because I think right now venture feels a bit lopsided. Either you're making like 10 million of ARR. So to me right now, venture just feels a bit lopsided with how much AI is being like invested into, where you have to get to like 10 million of ARR in like 18 months. For the average founder, like that feels incredibly lofty. And then if you don't get there, you've raised so much money that like your business is not really worth anything to you or your employees because you've sold so much capital and all of that's pref equity. So it's like they have to be paid out before you get paid out. So then you're kind of left in the situation where like you're probably bought by a competitor and it's not really like that good of an outcome. But if you're bootstrapped, you have a lot more options. Like I don't need to build this business to be a 10 million ARR. Like you can build it a 1 million ARR and it can be an incredible outcome for everyone. And so I think that's kind of how we're going into this, where we'll probably raise smaller rounds because at a certain point, it's too many customers for the amount of employees that we have to support. And we just need to move a bit faster and we need to hire someone and we may not have the capital to do it. So then we'll raise a little bit of money to hire and then kind of just go down that journey there.
And speak to us as a startup founder having successfully raised capital. It's not necessarily easy for a startup. You were probably raising in maybe 2024, maybe it was a high interest rate environment. I would think that maybe there wasn't that much liquidity in the market. Maybe a lot of people were kind of holding on to dry powder, waiting for opportunistic investments. Talk to me about your experience raising capital. I feel like it was friends and family. So if it wasn't, kind of zoom in and help us understand how you set the foundation to then go on to successfully raise capital.
Yeah, so we've mostly done friends and family rounds and some high net worth individuals. We also participated in the Techstars accelerator back in 2020. So that also was helpful. That helped us kick off like a medium sized round where we got some micro venture investors to come into the round. But we've primarily done like friends and family rounds just because of speed to close. You can close those very quickly. You just email everyone and like 2 or 3 weeks later, funds are in, you sign all the docs, and then you're done.
Awesome. So congratulations. For you, Domingo, personally, what are you investing in, if you don't mind me asking?
Yeah, I mean, transparently, I just do S&P 500. I've taken out most of my money from single name stocks just because so much of my time and effort goes into Homebase that I don't want to distract myself from that with like, hey, let me, look at this random investment I made. Because ultimately, if Homebase is successful, like these small investments don't mean anything to me. Like Homebase is like the majority of my net worth, so I should be fully focused on that.
Okay. So with respect to the stocks, is it more ETFs then, or is it kind of exiting all positions?
Yeah, more ETFs. So things I don't really need to think about. And I'm not trying to time the market by any means. So.
And how important is that mental clarity to just kind of cut out all the noise and just focus on Homebase?
Oh, I'd say really important. I remind this to my co-founder sometimes because people will start talking about like, hey, like all this stuff happening with NVIDIA and like Oracle and like all these different big bets people are making. And And I'm like, guys, don't waste your time thinking about like these small bets you're making in these single names. Like, there's so much more value to create what we're doing at Homebase and, you know, these small investments. Even if you 2 or 3 or 5x, like that doesn't mean anything in the grand scheme of like what we're building.
So I want you to unpack this a lot more for me. Imagine you're on the elevator with your hypothetical niece or nephew. You're trying to explain this to a fifth grader, the importance of doubling down and just simplifying your life to aggressively scale. How would you explain this to them?
Yeah, I'd say like to the point of simplifying your life to aggressively scale, think about the opportunities that are available to you that you can get maximum leverage on. If I think about what that is for me today, like any amount of revenue that I close on Homebase has inherently a multiple in the valuation of the company. So if you like, and software companies can be valued anywhere from like 3 to 5x revenue. And sometimes it goes aggressively like 10x, depending on like the market industry. Do you have AI in it or not? So every $1 I close, that's basically a 10x value creation that I'm doing. And so then I know like, okay, this is theoretically the best use of my time to continue like, you know, closing more customers, scaling the business. And then as you scale a business, you start getting word of mouth, you start getting referrals. So then that flywheel goes even faster. But theoretically, like think about the opportunities in your life, think about where you can get the most leverage, and then double, triple down on the areas that you think gives you that most leverage, whether it's, you know, starting a company, whether it's the opportunities that are available to you in terms of a job. For my 5-year-old niece, it's probably going to be school and thinking about like, you know, what courses she wants to take or like in the, what she wants to grow up to be. And then how can she best position herself to do that today? Um, that's how I'd be thinking about it.
Awesome. I love it. Your 5-year-old niece is obviously very intelligent to understand leverage. What I would say is, Domingo, talk to me about maybe some of your coworkers at Google. Did they leave to start their own startups? Are they still at Google? Did they get laid off in one of these tech layoffs? Help me understand what life might have looked like if you didn't go down this path.
I mean, at least for me personally, I probably would have switched to the Gemini team. They're doing some incredible things, and I know multiple folks there. But honestly, everyone I know is still at Google. Luckily, they were not affected by the layoffs. But Google just attracts amazing talent, and people that are there are very happy and like what they're doing. Although I'll say it's been a bit stressful with the layoffs that have been happening because people are like, I don't know if I'm next. But then that leaves people working hard. And I think there's been renewed energy since Sergey came back, and it has really taken the reins as to, you know, the AI strategy for Google. And I think that's been very noticeable in the last like year.
Awesome. Awesome. For you, with respect to the current customers that you serve, do you feel like the customers that GP raising capital is that customer, the client that the GP is helping make money passively? What does that whole ecosystem look like from your perspective?
Yeah. So for me, I'm trying to curate just different GPs that are raising capital. So my customers, you know, general partners of different real estate investment firms, fund managers, folks that are either operating properties, deals, or raising capital. That's my investor base, or sorry, that's my customer base. And then, of course, they have their customers, which is LPs, and we do service those as well. And so giving them the best experience, because even though they're not ultimately the buyer of our product, they do experience it, give feedback to the buyer, and their experience and their feedback matters a lot. So to keep both in mind.
What is the common negative feedback criticism that you receive with respect to the platform or servicing the platform?
Yeah, I'd say like not having certain features. Like we what ends up happening with some legacy software players is there's a lot of feature bloat. Like you build something for someone and they're really big, and then you find out it's not really useful for someone else, but you've already built it and you want to monetize it. So you're charging everyone for all these different features. We stripped down a lot of that when we built Homebase to like, what are the core workflows people use when they're raising capital and when they're managing investors post close? And so because of that, we are missing a lot of things. We're a 4-person team. Um, and so people will complain like, hey, you don't have this, you know, this other feature, you don't have this, you don't have that. And I'm like, hey, like these were intentional decisions. And like, you know, we were very transparent about it. And we don't think they're like that big value add. Yes, it maybe saves you a little bit of time. So I'd say like that can sometimes be the negative piece. Yeah, I'd probably say like that's probably the piece that comes up the most. And then we have to prioritize like what do we want to build next. That's always
I
fun.
love it. I love it. Domingo, circling back to that, limited partner, that LP, that, passive investor, that everyday person who's looking to deploy capital. From your perspective, you've gone from making, 150K plus, working in a stable job, to investing in real estate, to raising capital for a startup. Help us understand what the profile looks like of somebody investing in real estate versus somebody investing in startups versus somebody doing both.
Yeah, I honestly don't think they're that different. I'd say there's a lot more people that invest in real estate than there are investing in startups. And also investing in startups is quite difficult. You basically have to have deal flow, and finding that deal flows can be a bit challenging because you don't want to just invest with like there's a million people raising money for companies, and the majority of times you're never going to hear from them again once you give them capital. So like actually trusting the people you're investing with, I think is few and far between. Especially folks that you think are like really smart. Well, I think real estate you could apply the same logic to, but I think inherently real estate's more stable. So you like there can be you still need a lot of trust in the operator, but like you don't think they're going to lose it all or like walk away. Especially they also a lot of times have deals they can point to. Like look at these 5 different deals I've done already, and that's almost enough to build trust. That's usually not the case for startup founders because you can only do so many startups, and if you have a successful exit, you're probably not going to be talking to the retail investor. You're probably going to be just going after venture because you already had like a big exit. But in terms of the profile, it's like I still say it's usually accredited investors. You really have all walks of life that hit them. What I usually tell GPs when it comes to capital raising is think about your buyer persona. So let's say you're a GP and you want to raise capital for deals, you're going to target dentists. So make all your content tied to what dentists care about because that's what's going to resonate. It's a sales process, right? You're selling someone a product. That product is either investing in your company or it's investing in a deal. And so you have to know what the buyer of that product cares the most about. In the case of a dentist, they don't have enough time. They want to spend time with their kids. They want safe, stable investments. And so that's how you sell the real estate, deal to them as like, hey, this is a stable investment. It's passive. I'm going to give you X amount every month. For the startup, it's about the upside and like you have to get people excited by the idea and the vision. And so that's what you're selling. So yeah, long-winded answer of saying like they really fit both. It's a matter of just like who you're targeting and how you're delivering the message to that audience.
I love that, Domingo. So if somebody's listening to this podcast and they want to learn more about Homebase, they want to learn more about you, maybe it's June 2026 and you guys are hiring and scaling aggressively and you have, 200 GPs on the platform. What is the best way for somebody to reach out to you?
Yeah, so you can find me on LinkedIn. Just Domingo Valadez is my handle. I post every day, and I usually post things that are tied to real estate. So I fully embraced the cringe, and that's honestly been amazing for our business. And then our website's homebasecre.com. So if you want to learn more about how we help GPs, how we help folks streamline capital raising, you can find out more there.
What is the cringe?
What is the cringe? So here's my take. I think every founder, whether you're a GP, whether you're someone starting a company, you have to own social media. Like social media is one of those channels that is just like incredible for organic traffic. And so I think everyone needs to almost become a micro influencer. And that is the cringe that I've fully adopted and I'm now deploying.
My condolences. We're gonna drive deeper on this one. Again, I'm that fifth grade, and I'm that 5-year-old cousin of yours. Help me understand what micro influence is. Help me understand why we need to master social media. Really break this down at a fifth grade level for the audience, please.
Yeah, I'd say like if I put on my startup founder hat and I looked even at my own market that we're entering, every single channel is incredibly busy. Conferences, there's like 5 different vendors. Ads are incredibly busy. Like there's just so much competition. But where there was not competition, no one really has a big social media presence. How like no one's really built an audience around their product. And so that was kind of the gap I saw. And I said, you know what? Let me become that thought leader, quote unquote, and like share the insights that I'm getting from all these conversations. And you inherently have something interesting to share if you're having conversations with like 50 plus GPs in a month. There'll be some insights that you'll take from that you can share with people. And so that was kind of the gap I saw. If you want to start a business, I think you should become a micro influencer because that is a free growth channel for you, that there's no cost associated with posting. And you can get inbounds in a world with AI. Now you can build a lot of tech much more easily. What is the moat? It's distribution. How do you get distribution? You can either pay for it or you can build it organically. And organically, like why not at least give it a shot? Do it for free. Start posting. Start sharing your voice, and become someone people want to listen to.
Thanks, Domingo. I love it. You referred to it as a cringe. I've spoken to other social media micro influencers, let's call them. Um, and behind the scenes is the thought process is most of them hate creating content. You calling it the cringe kind of refers to that as well. Help me understand from your perspective, why would you do something that you don't want to do?
I'll be clear. I don't mind. Like, I like social media. I've enjoyed it. I just think people find it very cringy. And so I think people, like, for example, always hate on LinkedIn because it's always people sell, like, I don't know if there was one that went super viral end of last year, and it was like someone proposing to their fiance, and it was like, I got engaged this weekend. Here's what I learned about B2B SaaS sales. It was like, wait, this has nothing to do with anything. And that went incredibly viral. So I think that is what people are referring to with cringiness, just because it feels like you're throwing yourself out there and you don't know how people are going to engage. But I'll say, to really make it as a startup founder, you almost have to embrace the cringiness, but also like just put yourself out there, and who cares what people think. Try your best to be successful. Of course, be honest in how you're doing it. But that's kind of the mental philosophy I have.
Do you feel like it's like commoditizing your own persona?
Yes, like, yeah, I'd say there's some people that even build audiences before they build businesses. They'll build an audience first, and then once they build an audience, they can then build a business, because you've already inherently, you selling a product is you building trust and selling that trust. And so like that's what you're doing when you're building an audience.
Is that a problem?
I think it depends what you're selling them. I think like if you're an honest person and like you're doing things to be good, I don't think that's a problem. I think if you're selling something that is not good and you're taking advantage of people's trust, I think that's bad.
What do you think most people are doing? If you don't mind me
I'd say
asking.
I'd say the majority of people, I like to think positively. So I'd say like probably the majority of people are doing it for positive things. But I mean, there's definitely bad actors or people taking advantage of their audience in some way, especially in crypto.
Domingo. Yeah. I love the insight, Domingo, because for me personally, like being on social media is the last thing that I want to do. But it's about finding
You
it's about
post so
finding
much though.
gaps. I know. It's that's why when you say it's cringy, I'm like, yeah, it's soul sucking. I hate it. But
Man.
it's about creating value, and it's about, do you want to create more value than your discomfort? I also like don't like going to the gym. I do that as well, right? So it's, conversations like this are about finding, stepping that, one or two steps outside your comfort zone, and that's where the most growth is, from my perspective. So that's why Domingo, I really love the conversation. I think what you've made clear today is that, raising capital, creating businesses, scaling, it's not just about finding the right friends and family, the right investor. It's about, creating and ultimately earning trust at scale. Domingo, I've loved how you've showcased the importance of having the right systems, the right strategies, the right messaging. That way, all your key stakeholders, whether it's that GP that's working with you or that, passive investor, that limited partner, as we'd call it in the industry, they don't feel like they're forced to invest. They feel like they have transparency. They feel like they understand how their capital is growing. So once again, thank you for breaking down what actually happens behind the scenes of a successful raise, both on the real estate side and on the startup side. Most people don't have your experience, Domingo, to be doing and have done both. If you're serious about syndicating or capital raising, consider reaching out to Domingo. If you're serious about growing, consider subscribing to MyFinJourney. Like this episode, share it with a GP or a friend who's looking to passively invest, and we'll speak more soon. Thanks, guys. Bye.